Hi, it's April 12th, 2020, roughly about 3 p.m. Singapore time. Today we will be going through quite an interesting topic, which is COVID-19 crisis investing strategy. In this particular segment itself, what I'm going to try and do is firstly have a look back into history with regards to some of the big crises or crashes that we've seen before, and it's stated there 1987, 2000, 2008, 1929, and also 1989. First four, of course, it's more with respect to the S&P 500, Wall Street, and the last one is for Japan. After looking at history, what I want to do is basically I want to build a what-if scenario, taking the experience or the data from history and superimposing that data on the current situation in a kind of like what if the current markets went through a Black Monday? What if the current market started to go through a global financial crisis again? Based on historical data of what happened, can we interpolate into the current data to have what we call a forward-looking model to try and see, especially visually, how it would potentially pan out if this repeated again for this current situation. Okay. And the third one is basically if we do get the current situation coming out in terms of a repeat of Black Monday, a repeat of the global financial crisis, a repeat of the Great Depression crisis or crash, what strategies when we apply produce the best results. So I've chosen three strategies. One is, of course, the lump sum investment where you go in straight away. Then the other two are considered to be dollar cost averaging, when you go in via installments. And here I've just chosen 6 months and 18 months to try and see whether among these three, which one gives us what we call a very good buy-in price for all the various scenarios. Okay. We won't be discussing the fundamentals behind the various episodes, what caused the global financial crisis, why we think that going forward it may mirror scenario 1, scenario 2, scenario 3, and so on and so forth. So we won't be doing that. I'll be basically trying to give you a very visual kind of presentation to make you try and understand how the current situation could pan out based on these historical scenarios, and that's about it. I mean, there's another time and place to discuss, Fed policy, all these kind of other things. Okay, all the charts are taken from Yahoo Finance. It's available, publicly available on the internet. You'll find a little bit of cut and paste and so on. So I do apologize if it doesn't look professional, because I'm just doing it at home and putting it one over another and trying to jigsaw and sew them into a nice piece of presentation. So do bear with me from that perspective. Okay, let's have a look back into history. Okay, we'll first start off with what we call all the different shapes. Okay, we've all heard the alphabet soup of A to Z type of shapes, and we are quite familiar with what we call the V shape, but I've termed the Black Monday stock market crash of 1987 a V shape light. Okay, a light version of the V shape. The V shape basically comes from the point whereby the market recovers in a very sharp manner. It's just down and up. Okay, here in the Black Monday stock market crash, markets went down by 36% in a matter of 2 months, and then after that rebounded back again. Okay, and after 21 months, retook what we call the previous high just prior to the crash. Okay, so it was down 2 months, and after that 21 months up. Okay. The normal V shape, which is the global financial crisis of 2008, you'll find that the markets fell by 58%, over a period of 17 months, so quite sharp in a sense from a V-shaped perspective. But it was really at the bottom there where you can actually see it was down in March, and then after that just continued to move, rebound higher in 2009. So there wasn't any consolidation at the bottom of the markets, and that's where it gets its name, V-shaped recovery. And basically it took 48 months before prices moved back all the way to overcome what we call the highs prior to the crash. Okay, the U-shape. Okay, the U-shape crash is basically, here I've taken the dot-com crisis to reflect what I deem as a U-shaped crash, meaning to say that markets took similarly, 20 odd months, 26 months, and 50% down. Okay, slightly longer than the V-shape. V-shape typically is a bit more sharper, but really it's at the bottom here that you get the U, whereby it's not just down and up, it's down and then there's a slight consolidation, as you can see, roughly about 9 months to 12 months consolidation before the markets actually started to move higher. And then it took 57 months for the markets to actually move higher back to what we call the original highs before the crash itself. Okay, and for the Great Depression stock market crash, okay, and do go to Yahoo Finance. They have data all the way back to early 1920s. Okay, and if you call up a few websites, you may be able to find some charts which go even before that, and here I've just added on a little bit to give you a better visualization of the whole cycle itself. Okay, but in this particular W-shape crash, what you can see is markets fell very, very sharply. In this case, 86%. Took about 33 months. Instead of rebounding in a V-shaped recovery, or instead of consolidating briefly in a U-shaped recovery, the markets actually went sideways in a W, or what some people call it a double V, and so on and so forth. But actually the markets actually went sideways and only really started to move higher after a couple of years, and then from here it went higher. This whole process back to where we started, i.e. The previous highs before the crash, took a massive 268 months. Okay, so basically we are talking about when it came to the Great Depression stock market crash of 1929, basically the recovery took at least 2-3 decades before we saw prices move back to the original starting point. Okay, so for the previous 4 crises, I've showed the S&P 500. I apologize if I didn't write down there, but it's the S&P 500. And you would think that the Great Depression stock market crash was the worst crash in history. But actually I've just added one more. I'm adding one more, which is the Nikkei, and you'll see why the Nikkei itself exceeds basically even this Great Depression stock market crash. So basically what happened in Japan, we all know that there was this massive asset price bubble in the 1980s, accumulated in basically the last month of 1989 before entering the 90s, burst, and then markets fell a whopping 64% in 32 months. This crisis itself is quite unique because after falling, the market seems to have, or was creating the W that we saw similarly in the Great Depression. However, because of subsequent crises, the Asian crisis, the dot-com crisis, the global financial crisis, so it kind of prolonged the agony of the Japanese market, so much so that it didn't really recover until the 21st century, so to say. So basically it took like 2 decades before the markets actually bottomed, and the bottom was basically 82%, 19 years after the market started to fall. And even after today, which is basically 30 years from the start of the crisis itself, the Nikkei still has not retaken back the highs of the bubble crash. So what started out as a lost decade, it's very famous for its the terminology lost decade. It looks as though to be a lost few decades at this point, and we're not sure when the highs on the Nikkei would be retaken actually from this juncture. Okay, so it looks to be quite bad for this particular case. Okay, so what we've done so far is we've had a very quick overview of these 5 different types of crashes. How long it took, how deep it went, how long it took to recover the previous highs. Okay, so in this particular section, and I call it the what if section. So what I do here is basically based on, for example, the V-light shape, which is the Black Monday. We all know that it went down 36% in 2 months. It recovered in 21 months. The total top to top, and the meaning here top to top is from the beginning of the decline till the full recovery back to where it started off. That took a combination of 23 months, which is just basically the decline of 2 months and the recovery of 21 months. That's 23 months. Okay, so what I've done is I've taken a snapshot, a kind of like a cut and paste from the actual Black Monday graph back in 1987. Okay, and I've kind of superimposed it now on this current situation now, where we stopped in April. This chart is basically April 2020. So we just kind of like superimpose that particular chart from Black Monday into here. Okay, what you get is basically a recovery, because during Black Monday itself, markets fell 36% and started to recover, whereas today markets have already fallen about 35%. So it's already done a similar pattern like the Black Monday, and thereafter, if we assume that it's going to follow Black Monday, therefore markets from today, or at least from now, will start to recover back. And if it follows exactly like what happened in Black Monday, post Black Monday, it will take roughly about 21 months before it regains back the highs, and therefore it would take the current market December 2021 to actually recover the highs. Okay, just a point to note, some of these months may be out by 1-2 months, yeah, so because I've been doing the manual calculation, but anyway, it's as close as possible. So let's try and apply some of these historical data onto the current situation. Let's move on. So let's assume today now that we are here again, April of 2020, with market is last close on S&P was 2789. What if we experience a global financial crisis, exact similar type of price pattern? Okay, so we would see what we call a 58% decline over 17 months, a recovery of 48 months, and a total top to top of about 65 months or 5.4 years, and it would look like this. So basically, top to bottom 58%, about 17 months. That would bring us to a bottom around 2021 July, and then a recovery of about 48 months. And that would bring us to June 2025 before we actually surpass the recent highs here. Okay, so this is basically superimposing the global financial crisis to the current situation. What if it's a U-shape? What if today currently the markets followed what we call a .com situation? Then we will get something like this. Basically, the markets would take 26 months to halve, i.e. lose 50%, bottom around April 2022, okay, at about 1,700, and then it would take about 57 months to actually move back to the previous highs that we saw in February 2020. So this is if we superimpose the .com situation into the current situation. Okay, and it gets much more nastier, as you know, as we move on now to the Great Depression crash. If we do that, what we will get is we will get an 86% decline over a period of 33 months, bringing the S&P to an unimaginable 475. The last time we visited 475 was basically in 1995, 1994. Okay, from there on, it would take 268 months for the S&P to recover, and only in February 2045, okay, would the S&P revisit back the highs of 2 months ago, 1 month ago, 2 months ago. Okay, and the nightmarish scenario would be if the current situation evolved into a Japanese bubble crash. Then what we would actually see is we would see that bottom in the first 32 months. Okay, that would take us down 64% to 1221. If we were so unlucky that there were crisis after crisis after crisis similar to the Japanese situation, then the next bottom would actually be 19 years from now, which is 82% lower. And until today, you know, we don't know when this would be recovering back to the February 2020 highs. Okay, so again, it looks bad, but again, I would term this as a low probability, high impact kind of situation. It's just here to show you what it could be if it followed a particular scenario. It's not here to say that this is our base case scenario. Okay. Okay, having understood the historical crashes, superimposing the historical crashes into the current situation to have what we call a visualization of how long it could last, how deep it could go. The big question now is, if you're an investor and you're looking to come into the markets, what is the best strategy to adopt? So here what I've done is basically I've chosen 3 strategies. One is the lump sum strategy, another one is the dollar cost averaging 6 months, and the third one is the dollar cost averaging 18 months. The lump sum, of course, is straightforward. You currently today, a market opens tomorrow, you go in, you put in your whatever amount that you want to invest in. Okay. The 6-month strategy is dollar cost averaging strategy is basically whatever you have. Let's assume it's 100%. Okay, you divide it into 6 months, which is 16.6% per month, and you start deploying, investing the 16.6% of whatever you have over a period of 6 months in equal amounts. Okay, and the 18-month is the same. It's just that now you're deploying over 18 months, a longer period of time. Therefore, your individual installments are basically much lower at 5.6%. Okay, so basically these are the 3 strategies. I'm going to run these 3 strategies onto the data that we have to try and see where the buy-in prices are. Okay, and how am I going to do that? Well, basically I'm going to use the monthly change from the respective scenarios, and then kind of try and model, do a very simple modeling to try and model and recreate the path of the expected path that the current markets are going to go through. From there I can actually average it out. Let me explain in a chart which may be easier to understand. So let's say, for example, for Black Monday. Okay, so when we go back to 1987, we can actually see the data, because this data is actual historical data. From here I can actually derive the monthly rate of change. That means how February has increased from January, how March has increased from February, how April has increased. So the change on a monthly basis, percentage change, 5%, 7%, 2%, 1%, whatever the case is. So I'll take this monthly change, and then I will just incorporate these monthly changes starting from April. So basically that set of monthly changes will now dictate where I think the markets are going to go from current level. So if current level is 2,700, then it goes up by 3% next month, 2% next month, 1% next month, goes down by another 4% the following months. Why? Because I'm just using the monthly change which I took from historically the Black Monday post crash period. So I'm just superimposing it, not superimposing, but I'm using the rate of change to try and model a forward-looking projection. Okay, it's a very simple thing, but I just wanted to explain how it's being done. Okay, so when it comes to Black Monday, the so-called V-light scenario strategy, if I were to apply a lump sum, currently the market is 2789, therefore everything goes in at 2789, so therefore my investment is locked in, priced in at 2789. Okay, if I do a dollar cost averaging, because markets are actually moving higher, I would actually be buying into markets that is moving higher, and therefore my average price would definitely be higher than my lump sum price. So my average price is 2973. Okay, and if I'm doing a longer term 18-month dollar cost averaging, then you'll find that I'm averaging higher and higher and higher into a market which is moving on the uptrend. Therefore, my average buy-in cost is at 3164. Okay, I think it's easy to understand when you talk about averages, and you talk about averages which are of 6 months and 18 months. Understandably, the 18 months one is higher. Okay, so from this perspective, if we do expect a Black Monday scenario whereby now we've hit the bottom in April, so to say, okay, and we're moving higher, then of course very clearly, if you're confident about that, then lump sum is the best scenario or the best strategy to adopt. Okay, let's apply these three strategies to the rest of the scenarios. So if you're talking about the 2008 global financial crisis, which is a V-shaped crisis, okay, if you invest currently in a lump sum, which is today 2789, and the markets go down after that, then of course you are locked in at your lump sum rate of 2789. If you average and the market's falling, so you average down, then on a 6 months dollar cost averaging, your average price will be 2278. And if you do an 18-month dollar cost averaging, your average will be a much lower 1995. The 18-month dollar cost averaging worked extremely well for the global financial crisis because the top to bottom was 17 months. So you're buying all the way down, and actually you stop buying almost near to the bottom of the crisis itself. So your average came out to be quite a nice average of 1995. Of course, dollar cost averaging never allows you to take the exact bottom because it's an average, but because it was a V-shaped recovery, the markets just took a couple of months before it surpassed your average, and therefore from then onwards you started to make money. Okay, those who would choose a 6 months dollar cost averaging, it would take a little bit more time, but soon enough the markets would exceed your dollar cost averaging buy-in price, and you would be making money. But those who went in on a lump sum, it would take basically about 1, 2, 3, 4 years, 3.5 years before the markets actually came back to your level where you actually bought in your initial lump sum. Okay, let's go to the next one. Okay, so what if the markets from now on did a U-shaped recovery or U-shaped scenario? So you would still, if you're doing a lump sum, you would be buying at 2789. Okay, unfortunately, because a U-shape takes a little bit more time than a V-shape, the markets would only come back to your level 1, 2, 3, 4, 5 years onwards, 5 years later, a bit longer time than the V-shape. Okay, so you would have to just wait it out because you're stuck at 2789. If you had bought based on a 6 months dollar cost averaging, your average would be 2488. If you had bought on an 18-month dollar cost averaging, then your average would be 2311. Okay, so the reason why this is not just quite near to one another is also because the market actually moved sideways here. So a lot of the 18-month dollar cost averaging was buying into was kind of like a single price because it was just chopping around in a certain range. Okay, so it happens sometimes. It's hard to predict, you know, but the 18-month, because generally it's a downtrend, so you tend to get a lower than a 6 months buy-in price. Okay, so again, the recovery, first one to recover and recoup back, start to make profits will be the 18-month. The second one to recover and start to make back profits will be the 6 months, of course, quite naturally. Okay. So therefore, in this situation, best one actually is the 18 months because it's lower, having the lower buy-in price, lowest buy-in price. Okay, so the interesting part, the markets fall like a stone. If you had bought at 2789, and true enough, if the markets go through this kind of scenario, then it will be an extremely long wait before you actually recover back to your original position. A 6 month dollar cost averaging doesn't help very much, especially if the market is choppy here. It goes down, it goes up. You tend to buy a lot of, it gets concentrated at the top, so your average for the 6 months based on this particular scenario is not that far off, but the market then suddenly drops much more. Therefore, if you're doing 18 months, it starts to buy at a sharply lower price. You get an average of 2164. Okay, so you still have to wait it out. This is kind of like a scenario whereby even an 18-month dollar cost averaging doesn't help to soften the blow, so to say, but it does help to give you kind of an average. I'll talk a little bit about why even in this scenario an 18-month is still preferred, or rather I'll just let you know now. Okay, because if we have a scenario whereby we think that things are deteriorating in an accelerated pace, after a 6 months DCA, you would have expended all your ammunition, so to say, or whatever you wanted to invest in. You would still be left in an 18-month DCA with another 12 months. You could jolly well decide that, look, things are not looking that good. It looks as though the market's falling like a stone. We've got whatever the case is, bankruptcies popping up here and there, systemic risk, whatever. I probably want to hold back my dollar cost averaging installments, which I have not expended yet. Or I may want to increase the length from 18 months to 36 months. Yeah. So what I'm trying to say is a longer term dollar cost averaging, if this is the scenario, would provide a little bit more flexibility to investors. Okay. And what if it's an L shape like the Nikkei? Then basically, again, anybody who had invested as a lump sum, very much in the same way as the Nikkei at 30,000 or 35,000, you would never see. I won't say you would never see. You until now, you wouldn't have seen for the Nikkei, and we're not sure for this projection when you will see again the 2789 level. Okay, your 6 months average is here 2175, and your 18-month average is just below 2143. And again, the reason being is there was this period of sideways movement whereby a lot of the 18 months buy-ins were concentrated in a tight range, so it didn't catch the downturn as it would normally catch it. It was stuck. A lot of the buy-ins were here, so therefore the average unfortunately didn't go that low. So sometimes buying into a long-term DCA also depends a lot on the shape of that decline. If everything is consolidating within a tight range for a long period and then there's sudden downturn, not a lot of your installments are being priced in at that downturn, but a lot of it get bunched up in that consolidation period, which is this case. So unfortunately, that is the worst case, whereby the dollar cost averaging, whether it's 6 or 18, you don't get much of a difference. Okay. So, and yet, if you just look purely at the numbers, the 21431 would be actually still the better strategy. And again, with respect to the flexibility given, whereby you could actually after 6 months decide that you want to prolong it, not 18 but 36 months, 48 months, or you just want to temporarily stop the dollar cost averaging, and you still have money with you to expand as the market drops lower and lower and lower, and you finally decide to use it. Yeah, so it's flexible enough to cater, I think, for these kind of situations, which I hope doesn't happen. Okay, in conclusion, okay, points to consider. Number one, please, as you can see from the charts, it's not exceptionally professionally done. Okay, a lot of cut and paste and stuff like that. So some resizing, and basically even on scenario section 3, where we actually start from the downturn. All these are, while I've tried to model it, the starting point may not be exactly, after market falls 30%, therefore then we start from there. So it's just basically a little bit of 1 or 2 months off from where it ought to be potentially. But the whole idea is not to give you a point to go in, but to give you an idea of the concept. Okay, and you visually can see how this concept works. Okay, so I hope you understand that, and my apologies. Okay, so we kind of understand now that lump sum itself, it's only if you believe the market's at bottom, you strongly believe the market's at bottom, then you ought to go in lump sum, because averaging up is not, it actually, you lose out on because the markets are moving up, and if you average up, your average buy-in will be higher. So if you truly believe the market's going up from here, 100% certain, then you ought to go in lump sum. Okay, just one point to note: of all the scenarios that we've discussed, second, third, fourth, fifth, all these scenarios have resulted in a recession, either in the US or in Japan. It's only the Black Monday scenario which did not result in a recession in the US. Okay, so if you want to bring in a little bit of perspective, one could argue that, hey, maybe this Black Monday scenario is a bit not applicable to the current situation, because the current situation seems to suggest we are in a recession, if not we are going into a recession. Okay, well, that's debatable again, but again, we're not going to talk about that here. This is basically just to try and help you understand the different strategies. Okay. We now understand also that dollar cost averaging is probably the best way of entering into this kind of markets. Okay, it helps you lower down the volatility in case the markets go against you, and in case the market even goes in your favor. You know, at the very least, you're buying into lower and lower prices. Okay, so you kind of protect yourself in more or less two ways. We prefer an 18 to 24 month dollar cost averaging. In fact, we've just launched for our clients an 18-month what we call market recovery portfolio, where we hope to take advantage of the markets today, and even if the markets fall further down, as you can see, an 18-month dollar cost averaging, as long as it doesn't move into a Great Depression scenario, even if it follows what we call the dot-com scenario, even if it follows the global financial crisis scenario, an 18-month dollar cost averaging strategy is excellent to try and get you what we call a very good average buy-in price. Okay, you could adjust. I know someone may ask, you know, what if, how do I determine what we call whether it's 18 months, 24 months, 6 months, and so on. Okay, one way of doing it is basically to set out what we call a probability expectation with regards to where the markets are going. If you think, for example, if you think there's a 30% chance of market going higher, but a bigger 70% chance of market going lower, then you try and expand or you lengthen out your dollar cost averaging, because your probability is slightly higher to the downside. Okay, if you think that actually the market has a 50-50 chance of either going up or going down, then maybe you just want to narrow it down a little bit to about 12 months, just an example. And if you think there's a higher chance of market going up than coming down, 70% chance of going up, 30% chance of going down, then you want to try and put in as much as possible in the front end, and therefore you narrow down your dollar cost averaging. Yeah? And of course, if it's 100% sure against 0% of it going down, then you put in straight away lump sum. Okay, so you can actually play around with this probability ratio and decide what is the length of time that suits your probability of markets going up and market going down. Okay, understand that under a depression scenario, even the long-term DCAs are unable to lock in a good price. As you saw just now, the prices are locked in. Still, it's low, but the thing is the market just went much lower. Okay, and again, but I still think the longer term DCAs have an advantage of being flexible if that happens. So you know, that is actually the best case scenario, having a long term DCA, just in case it turns out to be this kind of tail end unexpected global depression type of decline. You know, I would like to say that it's a low probability, high impact, tail end, 2.5% probability of happening. But the problem is we've seen just so many unprecedented things happening today that we really just have to take that into consideration just in case. So I'll leave you with this final slide. Howard Marks, who is the founder of Oak Tree Capital Management, a very famous billionaire investor. Warren Buffett openly, publicly says that, you know, whenever Howard Marks sends his notes, it's one of the first things I look at, and I open and I read and I try and understand the markets, because he looks very highly towards Howard Marks. So Howard Marks recently, in his most latest investment note to investors, said this: there's no logical argument for spending all your cash, given that we have no idea how negative future events will be. So basically he's saying, you know, lump sum, putting everything in, there's no logical argument for you to do that. You know, what I would do is figure out how much you want to have invested by the time a bottom is reached, whatever that is, and spend part of it today. In other words, this is talking about dollar cost averaging. You know, if we have a scenario in mind to say that markets are going to go lower, well, maybe then I will have to decide whether it's 18 months, 12 months, 24 months, and so on and so forth. So if you start to do that, means you start to deploy your installments. stocks may turn around and head north, okay, but you'll be glad that you bought some. So even if we DCA thinking that the market is going to go down, if suddenly the market turns up, well, at least you got some of your installments in the markets, which can take advantage of the market, and then that gives you a bit of time to start thinking of, okay, what do I do with the rest of the dollar cost averaging? Do I bring it forward? Is this a bear rally? And so on and so forth. Okay, or they may continue down, in which case you have money left and hopefully the nerve to buy more. So again, if you already started to put in money and the markets continue to go down, okay, you are, i.e., if it's the intention is an 18-month dollar cost averaging, you've just expanded 4 months, you still got 14 months to expand, so you're actually getting a nice average as you deploy most of this or the rest of your investment. Okay, the only thing is, and he's absolutely right, hopefully with some nerves, because we've experienced before clients, investors who do DCAs, but as the market falls, they lose their nerves and say, look, you know, I'm actually buying, yes, I get lower prices, but the market seems to be a bottomless pit. And then they stop doing their DCA, and then when the market suddenly moves up, then you know you find out that you've not deployed effectively the capital that you intended to. Okay, so it's really a very disciplined kind of methodology strategy which you should follow when you deploy dollar cost averaging. Okay, so the experts are actually calling for it, and we totally agree from that perspective. Okay, so, hope this has been quite informative for you. If you like this video, and in order to get notified of subsequent videos, please do like our YouTube page. Again, all information here basically is just for education purpose. If you do need to invest, please approach your financial advisor who do the necessary risk profiling and to see whether some of these strategies suit you. Okay, thank you, and I hope to see you at another time.